speaker that is here tonight, and we're extremely grateful that he has made the drive all the way up here from Denver. And so a little bit about him, he is a chair on the National Association of the State Boards of Accountancy, which is also NASBA, which if you're familiar with the Student Center for Public Trust, that's who organized that. And he is also a member of the Public Company Accounting Oversight Board, which is the PCAOB, and he's part of a group called the Standing Advisory Group. And so please help me in welcoming the Partner and Director of Quality Assurance at Eks&H, Galen Hansen.
Well, thank you, Caitlin, and thank you for inviting me again. It's been a few years since I've been up here. Before I get started, I wanted to share just kind of a couple personal stories with you, if you will, that I think might make some of this a little bit more meaningful as we get into the cases that I'm going to cover with you. And let me say, first of all, that from Eks&H, every year we have a requirement in our firm that we cover ethics every single year for everybody in the firm. It doesn't matter whether they're a secretary or a mail person, anyone within the firm, administrative or otherwise, all the professionals included, even our interns end up taking ethics because we think we're so committed to that. And I'll mention a little bit why that is the case as we go through. It should become fairly obvious. But I want to go back to the period of time when I was maybe a little bit older than you in my career. I started my career in Los Angeles, and I was with one of the big 8 firms, a firm by the name of Arthur Andersen, which you've probably heard of before. When I was promoted to the senior auditor in Los Angeles, which is where I lived, I had the opportunity to go to the new senior school, and the firm held a new senior school on the East Coast and out on the West Coast. And I went to that school to learn how to become a senior and what was important in my career going forward. And they brought in a guest speaker, and the guy's name was Leonard Spacek. And I don't know if you've ever heard of Leonard Spacek before, but when I first heard the name, I thought this was something from Star Wars, you know, maybe a cousin of the Spacek. But Leonard Spacek was really sort of a rock star in the accounting profession. He was the guy that took over from Arthur Andersen after Andersen died. And he was the individual that made the firm into the giant that it ultimately became. And so, you know, he was really, I was really tuned into this guy to find out what made him tick. And what I found out about him was it was all about ethics and integrity. And in fact, he coined the firm's motto, and that motto was think straight, talk straight. Talk straight, think straight. And that was sort of a famous motto within the firm. But as he gathered us together and he spoke to us, he said something that stuck with me throughout my career. And that was, he told us that we were among the best and the brightest. Okay, great, nice compliment. But then he said something very important, and that was that we didn't learn what ethics meant and understand what ethics meant and lived an ethical life, we would fail miserably. And I thought that was just unbelievably prophetic. When you look at what happened to the firm about 20 years later. He died 2 years before the firm went down. And it was probably a blessing on his side. He worked so hard to make it happen. But then I want to roll just to about 4 or 5 years ago when I was on the state board with Dr. Turner. We had some hearings, and the state board has on a regular basis hearings as they update their rules and regulations that CPAs are required to follow. And we had this hearing on the ethics requirement for continuing professional education. And we brought in all of these folks that would share their opinion. And at that time, it was 2 hours every 2 years, or 1 hour a year, right? And these folks kind of said something that echoed what Leonard Spacek said. He said, they one after another, they said, you guys can know you're smart, okay, we get it. You're CPAs, you can solve problems. But then one after the other, they said that ethics was where the problems are. That it wasn't solving problems, it was CPAs and people living ethical lives, knowing how to apply ethical principles. And so, that was sort of a reminder. And then when I was talking to Alfonso Alexander, he's the director of the Center for Public Trust in Nashville, and I think he's been out and spoken to the chapter here. And I told him that I was coming and talking to you students tonight. He wanted me to make a point, and that point was that within the first couple of years in your careers, you're probably going to be approached by people from time to time that might ask you to do something maybe not quite right. And as you think about this presentation tonight, and especially the cases that we go through, maybe that will ring true. If you're not feeling comfortable about something, now's the time to speak up. Now's the time to think about what makes you feel uncomfortable. So with that in mind, I'm going to go through this short discussion, and then we'll hit the cases. As I said, we have a 2-hour course internally within the firm, so I'm going to have to rush this, and I deleted a lot of the slides. But I'll go through these fairly quickly, and then we'll have more of a discussion. So if I can figure out how this works. So we talk about why we study ethics and what ethics are, and then how you identify ethical dilemmas and making good decisions. And then we're going to talk about those cases. And so we have that discussion. And it's a big darn deal. And these are some clips that I gathered that I share internally within the firm, but we have a problem within our society of people telling the truth and thinking that it's okay not to tell the truth if it'll get them ahead in life. We talk about, within the firm, we talk about trust a lot. In fact, the last few years we've been reading this book, everybody within the firm, it's called The Speed of Trust. Stephen Covey's son had written it. And the point of this and this pyramid is that if you work your way up it, is there's a cost to not being in a trusting type of environment. And it's going to cost you money. Not only is it going to be a big risk to your career, to the firm, or wherever you're working, but as an individual, there's a cost. And it just shows some of the things that, the reactions that clients or customers or whomever you're dealing with, if they don't trust you, what some of the consequences are. This slide talks about some of the top ethical issues in business, and the source of that is a magazine chief marketing officer, and they were correlating ethics to the costs that companies incur, and these how they ranked the different types of practices where there's problems that they incur, where basically are going to pay a price if there's a lack of these different types of attributes that people don't have as you're dealing with them in business. Honesty and ethics in various professions. This particular slide, and I think there's something missing from it, but it takes a lot of different professions. And this is the Gallup people, and they basically interview people, and they rank in these different fields from very high to high, average, low, or very low. And there was supposed to be a little cutout box in there that says they hadn't done accountants for a few years. And I know you're not all accounting people, but we came in at about 43%. So we have plenty of room for improvement. There's my box, 43%. Okay, so I was right about that, but it just didn't quite right. A few key points that we do want to make. The Ethics Resource Center is an important not-for-profit group. They say that there's a crisis of ethics within our society, and it has to do with declining ethics standards. And part of their what they say is that there's no universal approach to solving that problem. And they point out that a lot of the problem is that many people have limited exposure to making ethical decisions, don't know how to make those, and don't have formal training. I had an interesting dinner a couple years ago. There was a fellow that I worked with a number of years ago that's a professor at Peking University right now. We were talking about China, and I was in particular talking to him about a lot of the fraud cases that they've had over there recently, and some of the problems that they've had in the area of ethics and honesty and audit failures and so on. And he said, well, Galen, you think about it. In China, no one has more than 10 years of experience being a CFO, so how do you expect them to have the same level of attributes that we have here in the U.S.? And I thought that was very revealing that, and there's been a long-term discussion amongst regulators. Can you teach ethics? Can you really change behavior by teaching? If I make you take 4 hours of ethics every 2 years, or 1 hour, or whatever it is that going to change your behavior simply by conveying to you ethical standards or ethical cases, or just doing like we are here? Is that going to change behavior? And that I don't know that particular problem, that particular controversy has been solved, and or whether it will be solved anytime soon. I think that a lot of people believe that you can teach ethics, and that's why we're big on it within our firm, and why regulators like the state board requires it on a recurring basis. So not black and white issue, and it's something that we continually need to focus on. And so what are our ethics? So just some basic reminders. There isn't a definition of ethics. If you were to go look it up, you'll find a lot of people trying to describe what it is. In its most basic form, it's essentially values that allows us to interpret whether an action or a behavior is considered acceptable. And I think that's probably, in its simplest form, what ethics is. And you can go a lot into philosophy, religious standards as far as what ethics are, but that's essentially what we're talking about. Here's a quote from the 18th century Scottish philosopher David Hume, his treatise on human nature. We are motivated not by reason, but by a general, continually present desire for pleasure and the avoidance of pain. And I'm reminding of my own children as they were growing up. Path of least resistance. That's the path that they were on, and that's not surprising to me at all. So, do your actions, your particular actions, are they reflective of your values? And these questions that I've listed here, I think it's important from time to time to ask yourself those questions, and just internally, just kind of run them through your mind as far as whether or not your behavior is consistent with what your underlying values and beliefs are. And if they're not, then you're going to have you're likely to have some issues going forward. What makes good people make bad decisions? Probably a lot of different things. I've listed some here that we see. Loyalty to the organization is a big one. The pressure to succeed. My friend, that when we were talking about China, he was saying that in a lot of cases it wasn't a situation where CFOs or controllers were stealing money, but they were under a great deal of pressure in their communities and their villages and so forth. And when they didn't meet certain income marks, if they didn't accomplish certain goals, they felt like that was a mark of failure, and therefore they would fudge the numbers so that they did meet those goals. And so, again, that pressure to succeed was really big in his mind. Feeling entitled. Someone owes me something. Believe that the rules don't apply to them. Don't view something as being illegal. Whenever you have someone you're dealing with in business, we say a client, show me where it says I can't do something. Whenever they say, show me where it says I can't do something, that's a huge red flag. I mean, you stop right there in your tracks. You have to know that you're not dealing with someone that is interested in doing something ethical. They just are interested in the final outcome. Again, feel pressured by peers or lacking resources. Those are all things that we see that lead to problems. The publicity test. I think this is a great test, great quote of Warren Buffett. I was with my wife at one of the investees of Hathaway, his big investment company. And while she was looking in the glass boxes at things, I was looking at some of the literature, and I picked up this quote. We can afford to lose money. We can afford to lose a lot of money, but we can't afford to lose one shred of our reputation. Make sure everything you do in business can be reported on the front page of your local newspaper, written by an unfriendly but intelligent reporter. That really strikes me as being that I've read, a biography here recently of Warren Buffett. It's called Snowball, I think was the name of it. It's an impressive character, and it's very reflective of his attitude and the success that he's had in his career. High integrity behaviors. Right at the top of that list, I think, is the one that I would place the greatest weight on, and that is humility. The willingness of someone else to listen and to be taught, I think, is very high integrity. And then you can go right down through the list of those. I'm not going to take the time to read through each one of them, but they're all important. Tone at the top. This is something that you may have heard this term a lot. Tone at the top is really important in terms of leadership. If you don't have the right people at the top of the organization, you're likely to have internal structural problems where the organization is going to fail at some point. I think it could be expanded. It's not just tone at the top, it's tone at the middle. It's tone at all levels. And so it probably should be expanded from that. But this is the desire to act ethically. If you don't have that desire, then you're really missing something. But a sensitivity to ethical issues, willingness to mentor and provide guidance, willingness to handle issues as they come up, and instead of just ignoring them. And then number 5 there is really important, that there's not in the organization a fear of retribution if things are reported. In other words, if you're just wanting to hear an echo that everything is well and there's no problems, then you're likely not going to have people stepping forward and challenging the status quo. Making ethical decisions, and so these are all different things that we're concerned about. I think that in the accounting profession anyway, to some degree, all of business, some of the major issues that are facing the profession is the lack of independence. It's been an ongoing discussion within the profession the last few years. The PCAOB has been talking about mandatory rotation, other things that they believe would increase audit quality, and it starts with independence. I think it's been overlooked. Supporting the public interest, really knowing and understanding who your client is. A lot of times people think the company is the client, but more often than not, it's an investor, it's people, it might be a creditor, it's people that put money into the company. And it's important that we know and understand who our responsibility, our fiduciary responsibility is to. And then at this point, we talk about ethical dilemmas. And an ethical dilemma is essentially when you have more than one person that has a conflicting position of loyalty or outcome in a decision. And then the difficulty in presenting two equally good or bad options, and a correct decision isn't immediately apparent. So you have this dilemma, and then you have to kind of work through that dilemma. So, you know, let's get there. So here, I like that slide. I don't know if you can read that on there, but that's a canon, and it says, you know how you say if you're close enough to read this, you're too close. If you can read that on there, it says if you're close enough to read this, you're within range. And the best way to prevent dilemmas is prevention. And so we have this little scheme that I go through with our people. And nobody really gets out this slide when they have an ethical dilemma, okay? This isn't something that would pull out. But if you work through these steps and then you see that there is a certain structure or thinking when we make decisions, that's the whole point of this. Is that and a big point of it is it's not on you. You know, you're going to be working with your associates and other people within your organizations. And a lot of times people carry this on their back by themselves, and that isn't the right way to deal with it. You need to have somebody that you can trust, that you can talk to, that you can bounce things off. The mentor that you select early on in your career, those formal and informal mentors that you might go to get their reactions. But, and again, I'm not going to read through each one of these steps, but there is a whether we realize it or not, there's a process that each one of us goes through when we decide whether something's right or wrong. Sometimes it's a snap decision. Sometimes it's something that we have some period of time to think about. And so with that, and I don't know how we're doing on time. I think we're doing pretty good. I have 10 cases that I usually go through, and these are all real-life cases. And the way this works is on the first page, we've got, how many, Caitlin, we got 6 tables here?
Yeah.
Okay, so I've only picked out 6 of those cases that I thought because of limited time, and they're the ones that are in purple there. And so each table is going to take one of the cases, and you'll read through it, and on the back is the solution. Now, don't look at the solution, because after you work through these, you're going to pick somebody from your table to kind of very briefly describe what the problem is, and then what your solution would be. And I'll warn you, there isn't a correct answer on it. There's a lot of correct things to do. There's a lot of things that you shouldn't do. And then when you're finished with your presentation, what we'll do is we'll talk about what really happened. What decision was actually made and what was done.
What number in it?
So we need to assign the cases. So how about that table back there? This table here, do case formation. You do 4. That table back there, 5. Not 5, like 6. Got 6. Over here, 8. And then this table over here, 9. All right? Why don't you take,
which scenario are we doing?
5 minutes? Don't look at the solution, all right?
We're doing 6. We're doing 9 here. Which one? 9? Yeah.
These are fun.
We're all the same here.
My ethicals hat on.
Yes. Show us how it's done.
Okay, so after you've had a chance to read through it, you should start talking within your tables as to what you see. It's basically usually different options and so on.
What is explain why you're gonna honor my parents.
What do you guys think?
All right.
Second one.
That is important. The disadvantages I think outweigh the advantages, especially since they put chairs now. And putting them in that position. Yes,
We're riding this one.
I know we come before I
You like Rick best?
Yeah.
It's like every line of
That he's involved. It's like every line of because he's you should go to somebody else. I honestly don't know, but I feel like 3 is a good starting point.
Right now it's either like
Well, we need to, why wouldn't you do it? If we can't say anything. Oh, well, it's, I mean, I guess I don't know truly, just variables, so, but this would be like a partner decision, something like this, but I would feel like, okay, if the client says that you can give them direct consent or something that's not necessary, then they should give you the courtesy of being able to discuss that with the bank and get their reasoning as to their justifications to that service. I don't know if that's something that you can, probably not something you can assume. Probably have to get the okay from the client first, but I mean, I think that would be a good place to start. Let's say 3, just like in the big picture though, when we're issuing a going concern, you're having some level of doubt that the company's going to be able to
here, you designate somebody that's disputed for your table.
And for them to all of a sudden, you know, in 1 year,
Somebody's gotta,
everything's
it's not that big a deal, it's not like.
making profits, margins,
As I said, it's not.
making great money. It's like a miracle. It has to be true.
Because that doesn't really make sense though. Like, that makes sense if Jets.
Who has cases?
Whenever we have meetings, like, whatever they don't.
So we're going
Well, I was here watching the but I don't do accounting, so I was like, so I was
Who are the CPT people?
And I think one's a good option as well. I mean, we're not obligated to do anything if we're uncomfortable with it. Because our firm name is going on this
CPT,
plan.
raise your hand.
We're responsible, you know, for
All right, just mix up all of them.
I mean, if option 2 were to happen, you kind of destroy that relationship even.
All right, why don't we get started then, and you can just, and whoever the spokesperson is. It's very brief.
It's gotta be.
Very brief.
that's like the
Don't read.
Oh, that's answer.
What are the issues, and what were the options, and what are your recommendations? And then I'll read what really happened.
situation.
And by the way, these are not problems that we have at EKS. These are outside the firm, but they're all real. They're all real. So do we have, who's two? Do you have somebody that, why don't you stand up and try to speak loud enough so everybody can hear you?
So we had a scenario where the new partner was put in charge of an acquisition audit. And there was kind of a little bit of a question because the seller was an old friend of the new partner, or of a partner in the firm. So there was but 2 months after the deal was closed, the seller stated that the manipulation in the financial statements had been committed, so that they overpaid $3 million. So that was going through. So before that even happened, the new partner thought that there was some litigation going on because there were some problems. And after he kind of reviewed some of the statements, he saw that they were pretty sloppy work. So he's thinking, I could have done a better job of reviewing it. It doesn't look very good. So his scenarios were exactly, should he just ignore it and hope for the best? Should he, try to correct it? Would that be construed as manipulation? And then should he bring it to the senior partner's attention? Or should I bring it to the seller and buyer and see what they think? So we all thought about it, and we thought the third one would be the best, because it wouldn't be good to go to the seller or the buyer, obviously, over the firm. And to do nothing could be construed as maybe that he was trying to do that would actually be so we thought by going to the senior partner and asking him what he thought would be the best way to do it.
Why don't you take a look at the back side, and it'll tell you that some of the thinking that this person went through. But while you're doing that, I'm going to, I'll read to you the real life scenario. Real life case, the partner followed option 2. That is, he went through the work papers and cleaned them up. In litigation, a forensic accountant examined the work papers and discovered the discrepancies. The partner was then put in a difficult position of having to explain under oath in a deposition why it was not a fraud, that he doctored the work papers. He wrote on the work papers the initials of other people who had originally done the sloppy work. This case demonstrates the perils of engagements that appear to compromise objectivity because of inherent conflicts of interest. The buyer probably recognized that their claim was weak on the merits, but was trying to exploit the appearance of bias that came from the friendship between the seller and the name partner in the accounting firm. And folks, this happens in real life, that someone would go in and maybe initial somebody else's name, and it's a big problem with working papers. And a big part of the Sarbanes-Oxley Act was to define what working papers are. And nowadays, after 45 days, we have to freeze those working papers. No changes are allowed to be made in those public companies. And on private companies, you're given 60 days. And so in our office, we're scrambling around the office to make sure that all the confirmations are in the file and all our work is done, all the checklists signed off and the conclusions and so forth. But at the end of that period, no more changes are made to the working papers. Any thoughts or discussion on this particular case? Anyone? One case. Real life. So who has the next one? 3. The big bath.
So the public company is faced with a significant write-down in intangible assets to fair value from a recent acquisition. The CFO tells the controller that they should take the opportunity to write down the value of all kinds of other questionable assets. But the controller's not sure if he should do this. He goes through some of the options. We decided that the 4th option was the best, just because he didn't want to go over the CFO's head and either ignore him or change it and get in trouble. They're not supposed to do that. So he instead goes to the auditors and kind of discusses it with them. But we at our table decided that he should also include the CFO, so that he's not kind of like excluding him from the discussion. Yeah, is that work for you?
That's fine.
Okay.
Explain your case, you know. we're gonna read the outcome here shortly. All right, so everybody knows what a big bath is. Big bath is a term that we often hear in accounting circles, and that is when you have a problem. You know you're gonna have a loss, and you have to take a write down, and then you have somebody come along and say, well, you know, there's a lot of other things that we could write down, and then we don't have to write them down in year 2 or 3 or 4 because we get them off the books, and that's called income manipulation. And we see that frequently. So it's not just trying to show that you're better than what you are on the upside, but sometimes you have to look at situations and saying, are people trying to show themselves worse than what they really are, so that in the following period they can look better. And let's take a look at this one, because again, this is a real life case, and it goes through the suggested resolution and throughout the first and third thoughts, and said that there might be parts of number 2 and number 4 that would be acceptable. But let's look at the real outcome. About 6 months later, the company filed for bankruptcy due to quality control failure at one of their plants. Federal authorities ended up getting involved, and in their efforts to identify improprieties, they found the work papers and journal entries increasing the unsupported write-offs. This bright line earnings manipulation was used as leverage to force the CFO and controller into criminal plea bargains that netted each of them 2 years in a federal penitentiary. The illegal earnings management had little or nothing to do with the demise of the company. In fact, the company emerged strongly from its Chapter 11 bankruptcy filing, but the public exposure, criminal plea deals, and the general cloud of accounting improprieties raised issues about management's integrity. This brought an end to the careers of most of the company's senior management and all of its board of directors. So, serious stuff. People end up in the slammer when they do some of these things. All right. So who's the next one? Who has case 4?
That's us. So our case is actually in the tax side of things, and so basically, a senior is put on a job that he hasn't been on before, and he doesn't have much experience with this job. And in this job, they have to value their inventory. They use the LIFO And so they do a sampling of the inventory in order to get the value that they set it at. And so the senior goes to the managing partner and says, I don't know how to do this part because I haven't done it before. And so the partner says, well, the managing partner says, this is how we're going to do it. We're going to sample it. We're going to take 1,000 samples, and we're going to use the best sample that is the most advantageous to the tax return for our client. That way we get the most money for them. And he kind of has a red flag raised at this point. He's wondering if this is an okay thing to do, to take the best one out of the sample. And so then he's faced with this dilemma of what should he do. And so it said he could just go along with it because, you know, the managing partner must be right because he's been on this project before, and so he must know. And then, or he could pass it on and say that he doesn't feel like he's experienced enough to do this, or for whatever reason he can't continue to be on this case. And then the third option is that he go to the partner above the managing partner and state his kind of scenario and why he thinks that it might not be the best thing to do, just to take the best out of the sample. And then the fourth option is to do some research. And we thought that it'd be a good idea for him to do a couple of things, to both research it and see if there are standards out there about valuation of inventory and using sampling to do that. And also, he should go to the partner above the managing partner and state his feelings about it and why he thinks it might not be okay to do that. And we, in this thing, in the second option, it said that they could use an average of the sample, and we thought that might be a more fair thing because a sample isn't something where you just take one of your samples and that represents the whole thing. That's kind of what we thought.
Thank you. All right, this has a fairly lengthening reasoning, but let me just say, kind of reiterate what I talked about earlier. There's going to be people that ask you to do things that you're not comfortable with. And this is an example of that. And a lot of, I talked about here the partner and something that he said. And, a lot of times you have to go right back to the source and ask them, what did you mean by that? And you might even have to go over that partner's head, as it talks about here in the case, is one of the options. But let's look at what the outcome was. And again, when you look at these outcomes, you'll see this over and over again. Somebody just going along with what somebody else is telling them to do. So a real life case. Despite his misgivings, he simply went along with what the manager said. Shortly thereafter, the senior lost the audit working papers. They were stolen while he was at a bar, and then this sort of freak, unexpected detail is common in cases in real life, and I can say that's true. Thus, the audit had to be largely done over again. Because of the loss of the work papers, the managing partner announced that he was going to dismiss this senior summarily and without severance, explaining that he should be grateful the firm was not suing him for damages. The senior then raised the illicit manner in which the inventory valuations were originally calculated and hinted that if he were dismissed without severance, he would go to the authorities and report the firm for tax fraud. Thus it was that the managing partner changed his mind and came to propose a new and generous severance package, and no amendment was ever made to the original tax return, raising additional ethical questions. A lesson to be drawn from this is not that by being complicit in a fraud, an accountant can arm himself to blackmail his firm later, if necessary. Rather, a firm needs to foster a culture that includes the sort of behavior to begin with. So, good job. So, all right, we have, let's see, probably my favorite one here, intimate conflicts.
Okay, our intimate conflicts.
Why don't you stand up so hear you a little better. You have room?
So a CPA walks into a bar. So he is a part of a bank, and he happens to see a female loan officer who is at his bank.
Well, hang on. He's an internal auditor, right?
Right.
Okay.
He he sees somebody at his firm mingling with one of their competitors or somebody who she should not be talking to, well, not talking to, but, okay, story leads to them going into a car, steaming up the windows, and it kind of clarifies that she should not be having this relationship with this person, as this person has an interest in the bank, and it is in their policy for her to not have this kind of interaction. It also turns out she has had an intimate relationship with the president of the bank that she's at. So the CPA kind of has a dilemma of, should he go to the president that might take her side because he has a relationship with her in the past? Or should he bypass him and go to his superior, the chairman of the board? So we decided that he should bypass the president and go to the chairman and hope for the best.
Let me help you out and clarify this a little bit. So what we're talking about here is, these are not all CPAs in practice. So this guy's he's an internal auditor for a bank. And he goes to this bar and he sees this woman who is one of the loan officers from the bank. And she's having drinks with a fellow that this guy knows is one of the main borrowers from the bank. And I think he's a real estate developer or something. He's borrowed a lot of money from the bank. And then, so this guy is sort of watching what's going on, decides to go out in the parking lot to see what transpires. And these two go out to the parking lot and they spend some time in the car and then go on their way. And so now all of a sudden, the guy, he has a dilemma because he knows that this loan officer has violated their internal policies. And what is he going to do? And by the way, he's also aware that the loan officer has had a relationship with the president. So can he go to the president and have a discussion with the president? All of this gets real tangled, right? And the point of this is that, we talk about debits and credits all day long and solving accounting problems. Now all of a sudden you're being asked to be a psychologist, right? And how do you handle an interpersonal relationship, and what are all the different options? And we'll see what this guy did. So if you want to flip over and look at some of the reasoning behind that, I'll share what actually took place. The head of internal auditing decided to do nothing. And a lot of times that just doesn't work. Let's see what happened. A few months later, the borrower defaulted on his loans and sought to renegotiate. An independent forensic accountant was brought in and discovered the borrower had an insatiable appetite for investing in exchange-traded stock options. Over the course of the previous 2 years, he had lost more than $10 million, and in doing so, also most of the bank funding approved by the senior loan officer. Since he had squandered so much time and money, his development project suffered. This ultimately led to a foreclosure on the millions of additional bank loans outstanding. The borrower had deliberately seduced the senior loan officer precisely to get additional loans from the bank. In fact, he had made an assessment from earlier meetings with her that she bordered on being an alcoholic, and that if he could get her to drink, he could easily seduce her, which he succeeded in doing. The loan officer lost her job and the borrower was prosecuted criminally. The head of internal audit lived for months in fear that his knowledge of the compromised relationship would be discovered. Eventually it was discovered and he lost his job. He spent an interminable amount of time in the months following giving depositions and testifying in court. So, real life situation, guys. These things actually happen. They happen all the time, don't they, Dr. Sherman? We ever seen any of these things? The first one we were talking about, doesn't that remind you of that case that we've got? That does. So these things, they actually happen. It's not just something that you're seeing on slides or somebody talking to you about ethics. So who has number 8? What you don't know?
All right, so ours is about Kathleen. She's a CPA who just started her own business valuation firm.
She was in 20 years of audit and tax practice and decided she really likes valuation, so she went into it and started her own business. Basically, she gets a call from an old friend, someone that owns a business that the company used to audit, and he asked her to do some valuation for him on a company that he's 75% owner. He's looking to get a valuation for estate tax planning. So she decides, okay, let's do it. She goes in, she does everything well, she keeps a critical eye on things, tries to make sure he gets a good but fair deal on everything, goes through it, and turns it in, feels really good about it, and doesn't hear from him for a few weeks. Eventually, after not hearing from him and not being paid, she decides to give him a call and finds silence on the other end for a few minutes, and he basically says that he wasn't too happy with it and feels that she was a little too conservative, that she should be a little more aggressive with the valuation. So some of her options, we got 4 options here. So the first one was basically, okay, well, I could go ahead and refine this a bit, and we can take a look and go through and change a few things and just hand it over to someone to do some refining entries. Number 2 says she can take what he said and kind of take it into account and just change a few little things that shouldn't change it too much and won't be too material. Number 3, basically she can say, this is my opinion, this is what I've done, this is my work, and I stand by it. And number 4 says that she could just withdraw from the agreement or from the relation and just leave it where it lies. So we decided that the first 2 were very bad. Both of those are an issue with your independence and making sure that you give an objective valuation for this client. We were kind of bouncing back and forth between the second 2. Both of those can be good, and I think we eventually decided that number 4 was a better option. Just withdraw from the client. If that's the type of person who's willing to fudge the numbers a little bit to be a little bit more favorable for him, we decided it's probably better to just disassociate with that person altogether.
Thank you. Good background on this. What I think this case is about is understanding what it means to be a professional. You folks are here engaged in getting that educational background, and you're going to become professionals. And this is an individual here that had formed a professional opinion, then that is being asked to compromise that professional opinion. And that's a pretty serious matter. Maybe we don't think it's serious, but it's not like McDonald's where somebody said, well, you forgot I didn't want cheese on my hamburger. This is different, okay? This is a whole lot different because you're dealing with lots of money and they're dealing with the integrity of a professional. So let's see what happened in real life. The valuation specialist followed option 1, naturally, probably the path of least resistance, as David Hume said earlier. Which issue lowered the inputs and values in a way that could not be supported by professional judgment. About a 1.5 years later, federal agents showed up on her door and handed her a warrant to examine her work papers. In such cases, federal authorities can become involved in various ways, such as if the appraisal was sent through the mail, or if the valuation has tax ramifications. The specialist called her lawyers, who learned the agents were investigating her friend for fraud. She eventually learned her friend had no intention of using the valuation for estate planning. Rather, he used it to purchase the minority interest in the business. The valuation supported him in paying $10 million for stock instead of $12.5 million the minority shares were actually worth. It turned out that his minority partner was having an affair with his wife, and it was she who alerted the minority owner to her husband's fraud. Another instance of a strange accidental fact on which these kinds of cases often turn. The business valuation specialist's records contained what appeared to be clear evidence of fraud. And then it lists those: a change in valuation methodology after the first report, the consistent use in the second report of assumptions supporting the lowest valuation considered. 3, production of one report followed by another with a much lower valuation. There were even scribbled notes in the working papers remarking, L wants the lowest valuation. About 6 months after the documents were taken by the federal authorities, the specialist was indicted for criminal conspiracy to defraud. Ultimately, she was acquitted by a jury, but only after 3 years of litigation and close to $1 million in legal fees, only partially covered by insurance. So again, I mean, you know, when you start compromising professional judgment, there's unbelievable ramifications that can grow out of that. And then we have, who's our last presenters? Case 9. This one's interesting.
Okay, so for our case, they were doing an audit on a company that had been struggling financially. So they issued a going concern, and then a year later, the company came back and basically said, everything's better, we're making a lot more profit, you know, we're doing good, but we're not going to do a whole audit this year. We don't want to waste all that money. And so they just substitute a review. And then while he was doing the review, he noticed a few things that were kind of weird, but he was like, maybe it's just sort of a thing. And then the next year he came back and he was like, we're still doing good, we're still making great profit, things are really turning around for us, but we're still not going to do an audit, and in fact, we don't even need a review this year. The bank says we don't, so it's fine, don't even worry about that. And so the auditor was obviously very confused, and he didn't feel right about it, because he knew that a lot of things had happened within this guy's own family that didn't really indicate a growing rate of profit. So we had 4 options that he could say. Basically, he's not comfortable, that he should withdraw but do a noisy withdrawal, which is where he copies all of the creditors in with his withdrawal, that he should go and talk directly to the major lenders, or that he should go ahead with the compilation on the grounds basically that it's not his duty to interject, he just does what the client wants. We debated for a long time about either withdrawing or going directly to the major lenders. We had a couple of questions about whether or not that was legal. But at the end, we decided about just going straight to the lenders, because you should be able to do that if the bank says that you don't have to do a statement.
Thank you. All right, so I know we have some non-accountants in here, so does everybody understand the difference between an audit and reviewed financial statements and compilations? Those are the 3 levels of service that accountants render. And the audit is the highest because it's giving assurance on the underlying numbers. And then we have a review, which gives limited, what we call limited assurance, but it's significantly less than what an audit would provide. And then a compilation that provides absolutely no assurance whatsoever. They're just financial statements. So that's what we're talking about here. And this case is about lack of professional skepticism. That's what this case, I think, is about. So let's look at what the outcome, what was behind all of this. So we had a situation where somebody had an audit and then came back and said, well, you know, we're doing a lot better, so now we don't need an audit anymore, we just go to a review. And then the year after that, talk the auditor into going to a compilation. In the real life case, the partner agreed to the client's request for a compilation. Within 3 months after the compilation was completed, the owner shut down the plant and let everyone go. The business was bankrupt. What had actually happened was extraordinary. After the first review was completed, the owner took the review report and pasted it in front of the previous year's audited financial statements. He basically passed off an audit. He passed this off as an audit, which he then used to get a new line of credit for $10 million. Most of the money he used for his own purposes to pay off personal debt or sham payments to buy materials from front companies that he had established. So fraud is going on here. So if you understand what he's doing here, he took the reviewed financial statements, instead of the review report that's in front of it, he took the prior year audit report and slapped it and pasted it in front so that it appeared that these financial statements had been audited. The next year, the guy's name was Lang, expected to do an audit again and sent the client an engagement letter. The owner sent a signed copy of the engagement letter for an audit to their financial institution as evidence that an audit was underway. But the owner sent an unsigned copy back to the partner and verbally again asked instead for a compilation. When he received the compiled financial statements, what did he do again? He took and pasted a copy of the prior year audit report on the front page of the statements and again tried to pass it off as an audit. And again sought additional credit. By this time, however, the financial institution had begun to get wise to what was going on. It suspected sales and inventories were overstated and sent inspectors to the plant. They found serious concerns about capacity, production, and other matters. As a result, they called the loan. This quickly led to insolvency. When these matters were placed in the hands of the bankruptcy trustee, he brought in criminal enforcement authorities to pursue charges of fraud against the audit firm. He also undertook it on his own authority to recover funds for creditors. Naturally, the audit firm was one of the best sources of recovery. And so, you know, I've actually heard of people doing this, where they doctor up documents to make them look and appear different than what they actually are. And this day and age of PDFs, I mean, you know people who can make those documents dance, right? I mean, they can do anything with some of the stuff that you can do on a personal computer these days. And you have to ask questions. You have to apply that professional skepticism in everything that you do if you are a professional. And realize that not everybody's going to be honest with you. And once you know that they're not being honest with you, then that's a whole different story. Then you can take action. So those are the 6 cases that I wanted to go over with you tonight. We're within our hour. I was told that if you had any questions, I'd be happy to try to answer those. If not, Caitlin, what would you like me to do? Share what's going on in the profession or something like that?
Yeah, if you want to, or if we do have questions.
Okay. Yeah.
So I know we just went over those cases, but maybe like in the early part of your career when you were working for one of the big 8 in Los Angeles, was there ever a time that you were faced with one of these situations where you kind of thought something was fishy and like that it was the first time that you got approached with something?
Almost every one of these cases at some time during my almost 40 years of experience, I've had a similar type of thing happen to me. One of the cases that we didn't go through was, it has to do with a client, well, it's an internal audit situation, and the controller telling the internal auditor who pays your salary. And I've had a client tell me, who pays your bill? And I had to get up and walk out of the room and leave and resign from that engagement, because at that point your independence is blown. It's just blown. And it's just how it works. But almost every one of these situations, you're going to find at some point in practice the situation that Dr. Turner and I have talked about. The lady was very innocently working with a series of restaurants in downtown Denver. And her and her husband owned those and decided to sell. And she prepared a package, and this is very common, a package of information for the buyers. And in that package, it had tax returns. And in just the prior couple of years, they had a lot of losses, repairs that were non-recurring. Well, when she went back into her TurboTax or whatever she was using, she pulled out those extraordinary type of expenses. In other words, she reprocessed that tax return so that it made it look like the restaurants were doing a whole lot better than what they actually were. And you know something? I think this person actually thought she was doing the right thing. She was trying to present the restaurants on an ongoing basis what the buyer could expect. I don't think she realized that she was committing a fraud. And the buyer was pretty sharp, was an attorney, and once he caught on to what happened, I mean, a lawsuit was filed, a complaint was filed with the State Board of Accountancy. I don't remember if we took her license or not to practice. I think she was
Been
either-
on probation.
on probation.
Yeah, she actually just came back.
Unbelievably embarrassed. Her professional reputation probably ruined as a result of what had happened there. So, yeah, I mean, these are things that we see all the time in the regulatory world. Let me just share with you a couple things that I think is happening in the profession. It's really important right now. There's a lot of emphasis on private company GAAP. There's a new committee, it's called the Private Company Council, that is meeting with the FASB quarterly, about 6 times a year, more than quarterly. I attended the meeting just several weeks ago. The FASB members sit in on that council. There's a lot of concern about complexity of accounting standards and costs of this accounting standards. There's sort of a new culture that's emerging back in Norwalk, where they're re-looking at things like development stage accounting and accounting for variable interest entities. Some of the real intricacies in derivatives, and some of the real complexities, some of the most complex things. And do those really apply to private companies, or are they more applicable to public companies? And so we're seeing probably some changes in how the FASB goes about setting its accounting standards. So I think that's one thing to kind of keep your eye on. I think that cultural change is fairly pervasive, and that it's going to be with us for a while. And there's a lot of people that are welcoming that. The other thing is IFRS. And I attended with the CEO of NASBA about 3-4 weeks ago in New York City, the 40th anniversary of the FASB. And they had invited us to this all-day meeting that they had, and they had all the prior FASB chairs there, and they spoke on various different things that occurred during their tenure. But one of the things that came out was that IFRS, as much as it's been touted, is probably on the back burner in the United States. We don't see it going forward for a number of reasons. One of which is that while it might be very suitable for a lot of countries around the world, in the United States we have a unique culture where U.S. GAAP is significantly intrinsic to the business dealings that we have here. And the questions have been raised about the independence of the IASB, and there's some things going on in Europe right now where that is really being challenged, where the European Union is threatening to pull out their financing of the IASB. So, I think the United States has really sort of dragged their heels on this issue, but with some good concern, and we'll just have to see where it shakes out. But in talking to the chief accountant of the SEC, and he was sitting at my table, a guy by the name of Jim Croker, who is now the vice chair of the FASB, and I asked him, he said, well, why didn't you tell me this 2 years ago? He says, well, I really couldn't, which I thought was sort of interesting. But from the very first day he was there as chief accountant, he had met with Mary Shapiro, the chairman of the SEC, and they agreed that there wasn't any way that they could make this happen anytime soon. So I know it's important. You're being exposed to IFRS. A good part of the world is using it. Within our firm, we have a number of IFRS engagements, but don't think that U.S. GAAP is going to be replaced anytime soon. So it's been great to be here with you. I hope I covered some things that were of interest to you. Ethics is going to be with us for a long, long time, and you'll probably be given the same little talk to improve sometime down the road.
Eks&H, and we really appreciate all being here. It's fun to see you and to be able to come to the Beta Outside meeting here. So we have a little gift, so just be sure before you leave to take that one, okay?
All right, thanks guys for coming, and if you guys have any questions, I'm sure, are you guys going to hang out for a little bit? There's a lot of alumni and stuff from Eks&H here, so stick around and mingle, or